Greetings and thank you for joining us at FutureMoneyTrends.com. I have a great guest for you guys today. He's a true real estate expert and wealth building expert. Exactly the type of person you want to know. Early on in his real estate career, he flipped over 50 homes and 25 high-end water lots. He appeared on HGTV's House Hunters, rehabbed and managed rental properties, built a number of new homes, developed a subdivision, and started 2 successful online real estate marketing firms. He also built a number of other companies and made quite a few medium and high risk investments along the way. It was his involvement, though, with the development of a Hyatt hotel and a very successful multifamily project that led him into the commercial multifamily arena. He is the author of The Perfect Investment, Create Enduring Wealth from the Historic Shift to Multifamily Housing. He also co-hosts a wealth building podcast called How to Lose Money and a regular author for Bigger Pockets. Our guest today is Paul Moore with WellingsCapital.com. Paul, thank you for being on the show today.
Daniel, it's great to be here. Thanks for having me today.
Well, Paul, I just finished your book. It's an absolute must-read for everybody. They can get it on Amazon. They can go to Wellings Capital. But I am a cash flow investor, and I like diversification. And one thing that I think has been wrong on the public when it comes to investing is they've been told to diversify 100% in paper assets managed by Wall Street. And so I'm very excited to share this investment that I would bet most people are not familiar with and they haven't truly participated in. And I think there's a big advantage, and this is really how, the wealthy are investing. And that's one of the things I looked for as I began to make more and more money. What are the wealthy buying? So I'm thankful that you're with us on the show today. Before we get into direct investment ideas on how you can profit from this, I want to get into the overall trend of real estate. What is the current trend for U.S. home ownership versus rental property, specifically for the largest generation in our history, the millennials?
Yeah, so, in 1995 or so, the government, in their great wisdom, took it upon themselves to tamper with mortgage qualifications. And they basically thought that, everybody should own a home. And so they made it so that, you remember, Daniel, if you could fog a mirror, you could get a loan. A friend of mine who was making about $40,000 or $45,000 a year bought an old mansion, about 6,000 square foot mansion, for I think it was $620,000, and that was his second home. And basically the mortgage company gave him this loan, and it wasn't long until he stopped making payments, and it was back to the mortgage company. But in 1995, home ownership began to soar in the U.S. from its historical low 60s to 69.2%. It peaked out in 2005. And then people started losing their homes. The recession turned everything around. Real estate, the bubble burst, and it crashed down from 69.2% to about 63%. And it's maintained, the home ownership rate has been maintained in that 63% range since then. As you pointed out, millennials are the largest generation. They're about 78 million strong. And they basically often feel, Daniel, like they don't need to be tied down to a home. They don't need to be tied down to a job and the friends they have today and, a 30-year contract on a seemingly overpriced mortgage. So, and often their student debt, which is at record levels, prevents them from getting a loan with the new requirements that were changed back to be more like the old. So millennials, by and large, are renting more than owning. The psychographic studies in 2005 said that there was a 60% preference in the U.S., 60-40, to own versus rent. And then from 2007 on, I believe it's been more like 40-60. More new homeowners are planning to rent than buy. And every drop in that percentage I mentioned from 69 to 63 represents about 1 million new renters in the renter pool. So that's the demographics for the millennials.
What about the baby boomers? That's also a large generation. Obviously, they had a very good experience in their lifetime with real estate, making incredible gains. Their houses obviously became banks, and from 2000 to 2006. Are the baby boomers in their retirement years? Are they going to hold real estate that they live in now? Are they? I know baby boomers who still have 30, probably 20 years left on their mortgages. What is the trend for that generation?
Well, the largest renter pool is the millennials. The second largest, I believe, is Gen X. But the fastest growing group of renters right now is my generation, and that's the baby boomers who were born between 1946 and the mid 60s. They're about 77 million strong, just behind the millennials, and they're renting more and more. They realize that their greatest investment, so-called, their home that they believed all their life, was not their greatest investment when they saw their equity go up in smoke, and they often lost their home. And they're renting more and more. And statistics say, Daniel, that when they begin to rent, they will never buy again.
Yeah, at that point, what's the point, right? Why get a 30-year mortgage at 70 years old? How did 2007 and 2008 play into this rental boom we're seeing in the United States?
Well, it's interesting. Multifamily and even single-family rentals are counter-cyclical in a sense. And that means basically that because of so many people lost their home and so many people got disillusioned, and so many millennials watched their friends, their uncles, even themselves lose their homes, that they begin to rent more and more. And so there's this really amazing graph in my book that shows that while real income dropped in the U.S. pretty significantly from 2006 or 7 to 2011, I believe, rents continued to rise. And the amazing thing is now we can look out another 30 or 40 or 50 years, and if the trends continue, the next generation after the millennials looks like it might even be larger than the millennials. And immigration also impacts that. There's a lot more immigrants regardless of what's happening in Washington, D.C., and their tendency is to rent more than buy.
Now, you've referred to in your book the perfect investment, commercial multifamily housing. So for listeners listening to this, there's the single family house, which everybody's familiar with. There's condos, there's townhomes. There is multifamilies, which is perhaps a duplex, a triplex, or a fourplex. And then anything over that is commercial multifamily. Please correct me if I'm stating anything wrong, Paul. But you call it the perfect investment. Why is it the perfect investment? Because there have been many, many studies that show, whether you have gold or bonds or dollars or real estate or stocks, there are many people who would argue that, a Vanguard index fund on the S&P 500 would be the safest way to go.
Yeah, kind of an arrogant title to the book, huh?
It's quite a claim.
I believe it's the perfect investment because the demographics we talked about, and there's quite a few more we didn't talk about. Also because of the Sharpe ratio. It's spelled SHARPE. And Daniel, you're aware of it. The Sharpe ratio is the measurement of return divided by risk. And it's a little bit more complicated than that. But the Sharpe ratio measures return and risk. And it shows that commercial real estate is several times higher in the return versus risk category than equities, than stocks, than the S&P 500, the Dow Jones, and even private equities. It's quite a bit higher. Within commercial real estate, of course, you have office, retail, industrial, and multifamily, and there's also storage units and a few others. But commercial multifamily over a 40-year period had the highest Sharpe ratio of all. And to me, that is the ultimate measure of a perfect investment. It's something that has the lowest risk with the highest return and the highest stability in a down market. We talked about it being countercyclical. A friend of mine in Atlanta, a financial planner, has one of his investors in his group who's investing $1 million with us. And the reason he loves it is that countercyclical nature, the fact that financial planners are always looking for an investment that goes up in good times and somehow continues to go up in bad times. And that's why I call it the perfect investment.
Now, just hearing commercial family properties, that you're talking probably about properties that are going to be more than $1 million. For those of us who are familiar with real estate or who have dabbled in it, everybody's taken on the task of buying a single family residence or a fixer or a rental property. It's kind of intimidating, the commercial multifamily property. So, for the person looking at this, why should we not be intimidated, or why should we perhaps be intimidated by this? What is it that you have discovered that makes this investing possible and realistic for the everyday investor?
Well, most investors who have tried to do a lot of single family buy and hold have found out that it doesn't take long till they're really frustrated and often quitting and sometimes selling their portfolio at a discount. I talked to a guy today who had 15 homes and he said, boy, I'm really pretty maxed out here. Imagine trying to acquire and rent 100 or 200 single family homes. That would be pretty tough. Now imagine trying to acquire and rent out 100 or 200 unit multifamily asset. A whole lot easier, especially when you're pairing it with a professional property management firm, which we do, and you have a professional asset manager in place whose interests are aligned with the investor. And so that's what we do. We do multifamily syndications, which means that we, as the sponsor or the syndicator, we are throwing our own dollars and our own time in the ring, and we are investing right alongside our investors. So our interests are aligned, and we're using a professional property manager. We're investing in large and growing markets. Markets that have all kinds of great criteria that we analyze to make sure they're fairly resilient in a recession and going up in good times as well. And so when investors invest with a good, proven sponsor or syndicator, they can know that they get a fractional ownership piece in a commercial multifamily property, which means they get incredible tax benefits. And they can also know that their money and their equity is being managed professionally and appropriately.
I can tell you as someone who owns over 10 single family homes, I am about done with it myself. And it's, I have very good management teams, like you're talking about how important it is to have them run it. But I don't know if you've ever heard this reason for not wanting to buy more, but it's kind of freaked me out. And it's happened to me 2 years in a row. But occasionally a tax bill for these 10 properties, and some of them I have county tax and I have state tax. So like in certain states, I have literally 2 tax bills coming for each house. And some of them will go to the property, or maybe it doesn't make it. And it's happened to me like in the last 2 years, one on 2 different properties where a tax bill slips through. I don't see it and it doesn't get paid. And it freaks me out because it's like, here's a bill that I just didn't receive, or it went to the wrong address. And, it's so crucial. If you don't pay your tax bill, you can lose your property. But, it just freaks me out. If you had 200 single family homes, you could have 400 tax bills coming in. And it just freaks me out about it. All these insurance things, it becomes more and more difficult to manage. Okay. So if somebody wants to invest with Wellings Capital, you guys find the asset, structure the investment vehicle. What markets are you guys in, and what are the initial steps for investors to partner with Wellings Capital?
Well, that's a great question. So first of all, we are looking for large and growing markets. And the reason is we want to get a professional property manager, and we want to have a couple options for a manager like that. And you can't get that in a small town. But we also want to make sure that there is going to be a sufficient buyer pool when we go to sell the property. It's also tied to the cap rate. which is the risk and it's tied to the risk and income profile for the property. But we're looking for large and growing markets. We believe that the market and the choice of the property management firm make up about 2/3 of the potential for success and the guard against failure for any given property. We're looking for net positive population migration. We're looking for low unemployment, a diverse economy. We don't want to be dependent on any one industry. We're looking for all types of things that would make for a great rental market. And so we are looking in cities like Birmingham, Alabama, Nashville, Tennessee, Chattanooga, Knoxville, the 85 corridor from Raleigh-Durham to Charlotte to Greenville, South Carolina, down to Atlanta. We're looking in cities like Dallas, Fort Worth, Houston, certain parts of Houston. We like San Antonio. We like places like Austin. We like places like Denver, but they're honestly overheated. We avoid cities where there's a wide swing in value during recessions and booms like Florida, California, Nevada, and Arizona. We're very wary of those places. So that's the cities we invest in. If somebody wants to invest with us, I recommend that they first get our book to make sure our interests and our goals are aligned. And then contact us, and we can go through a couple phone calls to make sure that we're on the same page. We want to know our investors, and we want them to know us. So we would go through a process like that, and if it makes sense for the investor and for us, then we would take more steps toward allowing them to invest with us.
When you guys come into these properties, are you guys looking for distressed properties that you guys add value to, or are you guys buying properties at or near market value that are turnkey?
We're honestly more toward the latter. We are looking for stabilized properties that have either value add additions we can make to improve the property, or management play additions, if you will, to where we can change something about the management and hopefully improve the income. But generally, we're looking for properties between 85 and 95% occupied who just could do much better than they are. We just feel like that fits our risk profile a lot better than an empty property that has to be completely turned around.
And then when you make the acquisition, how is the structure with equity? Does Wellings Capital and the investors who own fractional shares in the individual property, do you guys have like a 30% loan to value? Do you have 20% equity, 50% equity? What is the equity stake that the company has?
Yeah, so we typically go after a fairly safe structure with the debt and equity. We typically go for a 70 or 75% loan to value in, again, an asset that's already performing well. And then our investors get paid first. They actually get paid 100% of the distributable cash flow every quarter. And we take a management fee just to, keep the lights on and keep us in business. And then there's typically, although it's not always this way, there's typically something like an 80-20 split where the investors get 80% ownership in the asset and all the tax benefits that come with that. And then we get a 20% ownership stake after the investors have passed certain hurdles. For example, investors might get a 8 or 9% pref or preferred return before we ever get a penny of the ownership at the time of a capital event like a sale or refinance of a loan.
How long are the holds typically? Do you guys have a set of criteria that you want to hold these 5-10 years, or do you guys evaluate each property with a different objective as far as the hold period?
Well, we definitely will be evaluating them individually, but we're looking for typically a 4 to 7 year window till we can either get a supplemental loan or a second loan, or refinance the property, or possibly sell. And there's a possibility we would do it in less time than that, even if all the conditions were right. But we'd be looking at the cap rate, the performance, the income, the needs of our investors, the other opportunities that might be out there. And of course, we'd be responding to the potential of getting unsolicited offers along the way. that would make us want to sell sooner. Now, typically, with our cost segregation study, which allows us to accelerate depreciation, the depreciation benefits, in other words, the fact that our investors typically get a negative number on their K-1, on their tax return, that typically runs out in 6 or 7 years, which means that investors will start to have to pay some taxes after that. And so we're especially kind of targeting that range.
And for Wellings Capital, if you could take us through the to give people an idea, what are we talking about? Are we talking about 50 units, 100 units, 150 units? What is like the last 2 transactions you guys have done? How many units were they?
So we have 196 unit 196 unit asset under contract right now in Tennessee. And typically we would be looking for 150 units or more, or portfolios, of assets with at least 100 unit minimum.
All right. Everyone, I highly recommend Wellings Capital and Paul Moore. I spoke to him, I want to say 2 months ago. I've read his book, and he has a proven track record of success. And I think this is the real diversification so many of us need. You're tied into the stock market. Even if you own a REIT, it's going to go. If the Dow goes down, the thing's going to go down right with the Dow. Real diversification. Whether you're buying precious metals or you're buying private businesses, or partnering with Wellings Capital to have them essentially be the turnkey operator that you can partner with for commercial multifamily properties. Paul Moore, again, wellingscapital.com. If you guys want to buy the book, I will have a link to their website as well as Amazon. The book is The Perfect Investment, Create Enduring Wealth from the Historic Shift to Multifamily Housing. And everything Paul said, everybody think about that. Think about the people you know, perhaps the kids or grandkids in your life. It's so true. No matter where you go, young people are either choosing to rent or they're forced to rent. It is truly a rental boom happening right now in the United States. Again, Paul Moore. Did I miss anything, Paul? If somebody wants to reach out to you, wellingscapital.com, correct?
That's right, and I really appreciate those kind words. And we're also looking forward to hearing you when your podcast goes live on our podcast. We have a wealth building podcast called How to Lose Money, where we interview successful entrepreneurs, investors, and executives about mistakes they've made in the past so we don't replicate those mistakes. So that's been a lot of fun, and we really appreciate having you on the show, Daniel.
It's a great show. All right, Paul Moore with Wellings Capital. Again, thank you so much for your time.
Thank you. I really appreciate it.